I'm Richard Green. I'm director of the USC Lusk Center for Real Estate, and this is Lusk Perspectives, a series of webinars slash podcasts that we do on the state of the real estate market. And today we are very lucky to have with us as our guest Selma Hepp, the chief economist of what is now Cotality. I think most of our audience would know it as CoreLogic. Selma, welcome to the podcast.
Hi, Richard. Thanks so much for having me.
It's always good to see you, Selma. I like to start these things by asking people to tell us a little bit about how they got to where they are, and then we'll get down to the meat of the topic today.
Well, it's been a 30-year story. And I say that because this marks 30 years since I came to the US. It was August 10th, 1995. And so
And if I may say so, then in these times, again, another demonstration of how one of the things that has strengthened us as a country is getting the smartest people from around the world to come to these shores.
Yeah, no, I think about, sometimes if the situation was then as it is today, if I would be here today. I came as an exchange student. I went to college. I got a scholarship. That's how I was able to put myself through school. And then I worked during my master's, and I had an assistantship during my PhD. So, I worked the entire time that I was going to school, but I did all my schooling here, and the system was obviously very receptive of us international students. And so I don't know if I mentioned I'm Croatian. And so yeah, so my entire career has been in housing economics. I started off well, I had a very short stint in real estate as a real estate agent out of my master's program. Didn't particularly like that because I am not a social, I'm very socially awkward sometimes. I know people say it doesn't come across like this, but can be socially awkward. And I don't like engaging, talking on the phone a lot, or doing all the stuff that agents have to do. And so I have a lot of respect for them, but I was not good at that. So I decided to go get my PhD, and that was on the topic of um, urban economics and how cities grew post 1970s out migration era out of the urban centers, and how started coming back to the cities back in early 2000s. And so that was sort of the premise of my dissertation. I looked at also the foreclosure crisis, the early foreclosure crisis, I say at the beginning of this millennium, during the Great Financial Crisis, how that distributionally, geographically looked across the city. And so I found that people that were um, located in areas that were closer to employment and closer to transit were less likely to go into foreclosure because it was easier to sell the home, hence the demand for urban locations. So I did that, and then let's see, what did I do? So during my PhD, I got a job at the National Association of Realtors as an economist, and I learned a lot about what I do today, actually, which is, being a housing economist, I suppose. And then I went to, so I was in the National Association of Realtors. I went to work after I finished my PhD to California Association of Realtors. That's where I met you, Richard, when I moved here to California. So that was about 13 years ago. And then I went to work for Trulia as a chief economist, and then I worked for a brokerage up in the Bay Area that was a Christie's affiliate that was later bought by Compass. Compass is now a big real estate company in the US. And then I came to CoreLogic, now Cotality, and I've been here for 5 years now.
I was going to ask how long you've been in Cotality.
Yeah,
5 years.
years.
Oh,
Yeah, yeah.
okay. Okay. And for those who don't know, Cotality is the go-to place if you want data on, in particular, things like mortgage performance. So a lot of the Federal Reserve research around mortgage performance, mortgage default, prepayment, et cetera, originations, and so on, is based on the data that Cotality provides. So
Can I
Selma,
add
yeah.
something here? So, we mentioned the brand name change from CoreLogic to Cotality, and that actually reflects that we have a move to being just mortgage performance data company to being sort of a 360-degree view of property. So now we have many different layers of data related to property, including well, we used to have property records, we have property records, but now we have a lot of elements that speak to the climate risks. We have climate analytics tool that looks at weather patterns, structural characteristics of a home, and we developed the score at the property level
Yeah.
to the exposure. So we do a lot more now than just mortgage performance.
So I want to come back to that score,
Mhm.
but let's start with what I think everybody wants to know about, which is what's going on in the housing market right now. So let's just start with a national picture overall. I mean, I think people know that the market is quite slow by historical standards at the moment, but could you fill out that statement with some more detail, or am I wrong when I say that?
No, no, you're absolutely right. We are in a third year, I would say, of really, really slow home sales activity. And it's, numbers that come up often is that home sales activity is at the levels that it was in 1995. So very, very few home sales annually happening at the moment. But I think what's even more important to think about is when you adjust for population growth, how much slower home sales is even then, So we are at the slowest levels that we've been, even coming out of great financial crisis. We're somewhere adjusted for households, somewhere where we were back in 1980s, in terms of the total home sales activity.
And
Um,
let's remind our audience, what were interest rates like in the 1980s?
oh, they were double digits. They were, 15 to 20% for a period of time. Although I think I heard even over 20% for some folks. But yeah,
Okay, even back then, that was a subprime loan. Even back
yeah,
then, it was
okay,
over
yeah,
20. But yeah, they were in the high teens
yeah,
for
they were,
sure. And so the point is, you have a level of sales relative to households now that you did in an era where you had interest rates that were more than double
yeah,
where
yeah,
they are right now.
yeah, yeah.
So really quite extraordinary. So let's talk about, what do you think are the principal reasons why sales nationally are so slow at the moment?
Well, I think one thing that you cannot escape from is affordability issue. We have huge affordability issue across many, many markets. Not all markets are equally challenged by affordability, but nationally the affordability picture looks pretty bleak. Very few people can afford. The ratio of income to prices is very well. So price income needed for to buy a home is very high, and so not a lot of people are able to buy. And then on top of that, coming out of the pandemic, what has been characterizing housing markets that contribute to the challenge is that we didn't have a lot of inventory, which has then put pressure on home prices, even when Federal Reserve started raising interest rates, even when interest rates doubled from those super lows in 2021, we still continue to see pretty persistent home price appreciation. So, and that was a function of very low inventories. So it was, low inventories, insufficient construction over a period of last almost about, I'd say, 20 years, maybe not 20 years, coming out of great financial crisis, so maybe 15 years. So sorry, I lost my train of thought. Not enough inventory, stronger rate of home price appreciation versus income growth, which led to a lack of affordability. And so here we are today. Not a lot of people can buy. But what's changed this year, and it's supposed to be a boost for the market, is that we do see more inventory now. That lock-in effect that we were really, really worried about has loosened some, maybe not necessarily among households that do have a mortgage at 3%, but we do have 40% of homeowners that own free and clear. And we have had a lot of second home purchases and investors over the course of last few years that maybe are deciding to let go of that property because holding costs have gone up so much. And by holding costs, I mean things other than mortgage payment, principal and interest, but insurance and property taxes. And so that's made it very expensive for people to hold on to some of these extra properties that they had. And so we do see in many markets inventories rising finally, which is helping provide buyers with some level of advantage because at least there's more inventory, but it's also helped suppress the rate of home price appreciation. So we are now at some of the slowest levels of home price appreciation since 2012. We're up only 1.8% in our latest data.
And that's year over year.
That's year over year, yeah.
Yeah, and so what about if we, and I know there's problems with seasonality, but if we look recently at month over month, what's it looking like?
I have, yeah. I do look at the month over month data. We don't seasonally adjust numbers in our Cotality HPI, but then that's why I compare it to the same months in previous
Yeah,
years. So I
yeah.
looked at May data for this year, and home prices were up 0.3%. And in the period between 2015 and 2019, home prices were up on average 0.8% during that this month, April to May. So this is one of the strongest periods within a year for home
Yeah.
appreciation. It's spring home buying season. So really, weak in a sense compared to that pre-pandemic average.
So let's talk a little more about inventory for a second. Is there a rule that you use about what level of inventory is a sign that the housing market's going to be in real trouble? Are we getting close to that level yet?
So, generally when people talk about months of supply and months of supply being at 5 months of supply, you
Yep.
have a balanced market. We are at like 3 months supply of month supply of inventory. But the reason why I don't personally care for that measure is because month supply is impacted by a rate of sales. So if you have slower rate of sales alone, your month supply is going to go up. It doesn't mean you have more inventory. It just means fewer homes are being sold. So I look at raw inventory data, and I adjust it for household formation and things like that. So in that sense, when you look at the total inventory per households, that is at some of the lowest levels that we've seen. Generally, you would be at about 2.2. Now we are at about 1.3. And I'm actually going to look at my data really quick so that I make sure that I don't give you wrong information. I just looked at this slide. So it's at 15, not 2, but at coming into 2000, the average was about 20 homes, new or existing, per 1,000 households, and now we are at 15. And it's been on the decline coming out of the Great Financial Crisis, and the lowest that it's been was at about 10-ish in 2022 and 2023.
Okay. So by historical standards, we still don't have a lot of inventory nationally. Okay.
No, we don't.
But of course, there isn't a national housing market. So let's take a spin around America. I'm going to start in the southeastern corner of the country and then kind of work our way counterclockwise in part so we can have more of an upbeat discussion at the end. But let's start by talking about what's going on in Florida.
Yeah, Florida unfortunately has been hit by so many so many things all at once. So where do I start? Well, let me start with prices. So home prices in Florida appreciated cumulatively most than any other part of the country. So in Florida, home prices today are up like about 80 to 90% compared to 2020. So in 5-year period. Nationally, that's about 40 to 45%. So almost double, right? And it's very specific to sort of markets in Florida and some Texas markets as well. why there was a lot of migration, especially to Florida during the pandemic, and especially among higher income households, which is, one of the reasons why you could get so much appreciation in light of it's a very the market was already very challenged in terms of affordability even prior to the pandemic, right? But then you had, a lot of higher income households coming in, a lot of home buying demand, and then in the midst of this pandemic situation, you have natural disasters, right? This is the area prone to natural disasters. We didn't, up until a couple of years ago, we didn't have uh, natural disaster risk properly priced into insurance costs. So insurance costs were relatively low compared to the risk and exposure. And also because of the concentration of exposure now, because you have much more construction in that area, you had accumulation of high value, your total valuation of real estate has gone up so much. And you have persistent natural disasters. So with natural disasters being more frequent and disasters more costly, the impact has been it has reflected itself in rise of insurance costs. So that was sort of the first thing that hit the market in Florida. And that wasn't just Florida, but because of such high exposure, it was notably higher in Florida. Florida also had some other things with it was really easy to sue people. And so there was some transfer of assignability, so I don't know if I'm going to explain this properly, but contractors could easily be sued for things, and so that contribute to some of those increases as well. And there's a lot of lawsuits, and it's not cost of insurance is not just about natural disasters, but it's also this component of our society where we have a lot of class action suits that are very, very expensive, and obviously that feeds into. So okay, so we have insurance costs going up, and then and then so it became really, with insurance cost alone. On top of an insurance cost, what else happened is you had this law being passed for condominium buildings where you had to have enough reserve to to update the building to the building standards where they're where if there's a natural disasters, the building becomes more resilient. That made it very difficult for folks who are on fixed income to come up with that difference for reserves and so you started to see a lot more condominiums being listed for sale because people could not hold on to them anymore. So that's where it all started. But it's sort of over insurance costs, slowing of the housing market. Now, coming out of the pandemic, you also had significant slowing of in-migration to Florida. It's actually one of the largest declines in the number of people coming into the state, right?
Yeah, as a matter of fact, what's interesting, if you look at ACS data, if you look at domestic migration for Broward, uh, Dade, and Palm Beach, as well as Hillsborough and Pinellas counties, so sort of Tampa, St. Petersburg, and then South Florida, there's been domestic outmigration for the
Mhm.
last year. And if it weren't for foreign migration, they'd be losing population right now.
Right, exactly. So that contributed to weaker demand. And then at the same time, you have various, the last few years, new construction has been very, dominant in that market. So a lot of new homes being added. And that all came to a stop with less migration. And now you have market that's, sort of trying to find its new price, right? And in many markets in Florida now, home prices are declining. You have much more inventory, you have weak demand and slowing, and so home prices are falling.
So do you think this could produce the kind of cascade, maybe not, at a national level, but before we had the great financial crisis, we had a series of localized housing crashes, right? We had the Rust Belt In the 70s, we had the Texas oil patch. In the 80s, we had California in the late 80s and early 90s. We had New England in the late 80s and early 90s. And the story of the housing market used to be, well, there was never a national housing collapse. Of
Mhm,
course,
mhm.
that changed in 2007. But we would have these regional collapses. Do you think Florida might be on the verge of one of those sorts of regional collapses?
Well, I don't know if it collapse is the right word, but it's definitely a market that's resetting. It's definitely a market in decline. Um, in terms of home prices, some markets are down about 8%. Do we see more home price decline? Probably. Um, but is it a collapse? I don't know. When you say collapse, to me, I'm thinking about like widespread foreclosures. For home prices down 40%. I don't see that happening.
Okay, I guess part of it is one of the things that you used to follow, your company used to follow, and I don't know if they still do, is the share of homeowners who are upside down.
Hmm.
And I think you stopped doing that a few years back because basically that number went to zero
Yeah, yeah.
with the
We still
increases in
do it,
house.
but we turned it into it's not anymore a negative equity report. It's now an equity report because
Okay.
so many people build up equity.
So are you starting to see people with negative equity in Florida, is I guess what I'm getting at.
Yeah, we do. We do. But what's interesting, so let me start with the national picture. Nationally, it's only about 2.1% of folks that are in negative equity. Coming out of great financial crisis, that was 40%. Sorry, 25%. No, 25%. 40% prices were down. 25% were negative equity. Now it's 2.1%. This is off of the lowest that we've been was 1.7% about couple of years ago. And this 2.1% has been the case for the last couple of quarters. So we haven't seen much increase there. Now, mind you, so it's a regional story, right? This is a national number that I'm sharing. There are many markets in Northeast where you see a lot of continued increase in home prices and a lot, like high single digits. That may be offsetting. But are we seeing significantly more people underwater? The highest market for people underwater is Louisiana, and that's about 5.8%. But that's been the case, this is also sort of an artifact of the great financial crisis because some people never regained back because you didn't see the same level of home price appreciation there that you saw maybe in California or other markets. So it's still not a huge risk to the national economy.
Okay. It occurs to me that when you say underwater for parts of Florida and Louisiana, it's not just metaphorical.
Yeah.
It's,
Pun intended. Yeah.
it's real, right? Right.
Yeah.
Okay, let's move. We're gonna cross over Louisiana. Let's move west to Texas. What's going on in Texas housing markets right now?
Well, Texas, a similar situation in terms of migration, although I don't see the migration hasn't slowed as much as it has to Florida. But what has gone up a lot is insurance costs and property taxes. In fact, property taxes is the biggest now issue in Florida as in Texas. And I think you actually wrote something about that where you compared like California markets versus Texas markets and how property taxes versus income taxes.
If you're at the median, yeah, yeah.
Yeah,
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 no, there are so many. I mean, I don't want to dismiss California's very real problems, but there are all kinds of ways that you are still better off and economically better off in California than in Texas. The most important bit, you're going to make a higher income for the same job in California as you are in Texas.
right,
And the number I really like, if you're a one percenter in California, you make so much more money than if you're a one percenter in Texas, that even with all of our taxes and all of their taxes, your after-tax income is higher in California at the 1% than it is in Texas. And then your cost of your house is more expensive and so on. But yes, the property taxes are high in Texas and they've been getting higher pretty rapidly because they have a real ad valorem tax system and their property values have been going up.
right, exactly. So we, unlike the Prop 13, which caps our taxes here, they don't have the same thing. And so, people have seen significant, so, especially during the period 2021, 2022, where you saw as much as 15 to 20% increase in home prices, that's now in 2023, 2024, reflecting in higher yes, did I mess that up? Higher property values, now higher property taxes. And it's again having an impact on fixed income folks, lower income folks. And so we do, and again, similar to Florida, it was also a market with a lot of new construction. That's another thing we talk about, like how much housing units get added on an annual basis in Houston versus the entire state of California, right? And then you have Dallas, you have Austin. I mean, you have, and then multifamily construction in those. So you have a lot, so when you're talking about, inventory shortages, these are not necessarily markets where it's not the same level of inventory shortages.
Yeah, so maybe we should also talk about when we talk about inventory, you're talking about you're talking about listings, right? You're not adding new homes and new communities into
So
that
I
measurement,
was now
or are you?
talking, yeah, I was now talking about new homes and new communities, but I'm also talking about existing home sales being put up for sale. Yeah, I'm talking about both.
Yeah. Oh, so your inventory is the sum of both of them.
Yeah.
Oh,
Yeah.
okay. All right. Because the story in Austin is we economists who love saying, see, it actually works, is you've had this big supply shift in Austin and rents have been falling pretty rapidly there.
Yeah. Yeah. Yeah.
So it's showing, and ultimately if rents fall, that should filter its way through to housing prices and you would have a softening
Well,
of house
yeah.
prices as well.
Yeah, exactly. So Austin is the only market, well, it's the market with highest decline in home prices since peak in 2022 before mortgage rates went up that hasn't recovered back. So Austin is down 13% from that 2022 peak, and it's only the only market with double digits decline since then that hasn't recovered. It's seen over the last couple of years, maybe a little marginal increase here and there, but it's still down 13%.
And do you know of it? I don't. Do you know offhand what's happening with migration in Austin?
Just that it's slowed. I don't know
But they're
exactly.
still in migration as far as
I think there is still immigration. Yeah, yeah.
okay, okay. So, all right, let's well, before we come to our home state of California, let's sort of stop for a moment and I'm going to just call them the desert twins, as Phoenix and Las Vegas, which were very famous for being among the hardest hit cities in 2007, 2008. What's going on in those places right now?
Yeah, so okay, let's see, where do I start? So similar, say, to Texas or Florida, a lot of new construction has happened in those markets. At the same time, a lot existing inventory. So the inventory increase is a similar story. A lot more inventory. Like Mountain West, outside the Southeast markets, Mountain West, like Denver in particular, but then um, Phoenix and to little lesser extent Las Vegas, you have seen similar increases in inventory. Also, as a result, slower rate of home price appreciation. But unlike these other two areas, not the same, not the decline in home prices. So we have not yet seen decline. And I attribute that to the fact that you still have outmigration from coastal California to Vegas and Phoenix. And we know that generally it's if it's a retirees, they have a lot of equity that they build up, so cash to work with, or they are coming with higher incomes. So the demand composition is different and it's holding up prices in those markets. So yes, home prices have slowed, but they're not declining there.
Okay. So now let's talk about where we live, California. What's going on? And of course, we probably should separate Southern and Northern California, along with in the Central Valley and Sacramento is another thing altogether. So tell us about what's going on here.
Yeah, yeah. Well, many different stories. Um, Thank you for the question. I love talking about California, but we should talk about Northeast at the end too, because
No, no, no. As I said, we're doing a counterclockwise spin
oh,
around the
okay.
country.
Oh, sorry.
So
Okay,
no, we're going to go up to the Pacific Northwest and then the Midwest. And as I said, that's why I wanted to start on the sour note and end on a higher note because I
yeah,
know
yeah,
the Midwest and the Northeast are doing better than the rest of the country. So
got you.
so
Okay,
so,
sorry.
so we'll get there, Selma, I promise.
Okay. Sorry, I missed that. But California, so let's see. Also a lot of inventory gains, which has been really welcome change in this housing market. If you've been shopping for a home in California for last, I don't know, 5 years, I mean, it's one of the markets that's been most undersupplied. No new construction, almost no new construction, right? And or very low rates of new construction, and not in coastal parts of Croatia, of California, but more inland parts. So not a new construction to supplement that inventory shortage. But now finally we do see more inventory from existing homes. And actually, some of the highest increases have been in California markets. And I think the reason is that, well, one is more people own homes free and clear in California on average, because they've hold on to their properties for longer because tenure is, because it's so hard to move because it's so expensive and no inventory and so on and so forth.
Well, and the other thing is, again, the property tax benefit of staying in place is enormous here.
Yeah, exactly. So there's all that feeds into that lack of it. But so now more inventory, and people are asking why, where is this coming from? So, California markets have also been one of the highest investor markets, but small investors, unlike, Atlanta's mega investors, we have a lot of small mom and pop investors in California. And so maybe it was for rental property, maybe it was Airbnb, or just second homes. But a lot of those type of purchases, and those are the folks now that are more likely to be putting their home on for sale, or retirees. That we do have retirees leaving state because it's expensive. We do also have issue with out-migration continued. So more inventory. Now price appreciation has also slowed, and it's actually home prices are pretty flat. There's not much change in home prices, I think because of more inventory. And then, you have sort of regional, even smaller regional things San Diego was really strong and booming up until about a year ago, I'll say, or maybe coming into this year. Why? Maybe because it was one of the most affordable coastal markets. When you compare San Diego to, like, say, LA or San Francisco, it was more affordable. So we did see more migration into that market from California, more expensive California markets. So that was the story in San Diego, and that sort of slowed down. And we do see some declines in home sales activity in San Diego. But then you have LA hit by wildfires that did impact, that did disrupt home sales activity, where we did see a burst in home sales in not just LA, but also Ventura County and Orange County from folks that have been impacted by the fires. So that would be the higher end of the market. But it did boost home sales activity, and it sort of impacted a bit of a demand for housing, to where it would impact home prices. But after that sort of, and that wasn't long lasting, which was very interesting to me. There was not it was only a couple months following the fire, and now we've sort of returned back to the trends we were seeing in these markets before the fire, which is more inventory. Demand is here and there for a good home. It's a lot of demand for not, good, well priced. It's all about property to property. I think the demand exists. It's just that if the property is properly priced, right? So as a result of that, a lot of times when people put listings, they tend to push to see how far they can go, and then they reduce the price. So we do see more price discounts going on. and essentially flat home prices. So that's SoCal. Mhm. You were going to say
Uh,
something.
what about the Bay Area?
The Bay Area, yeah. The Bay Area is declining. The Bay Area is not well, when I'm talking about the Bay Area, I'm talking about San Francisco and Oakland, not South Bay. San Francisco, Oakland are really weak. Oakland is one of those markets that is now seeing a year-over-year decline, as in San Francisco. But then South Bay is doing really well. South Bay has much more sales activity. It has positive home price growth. And then you have these other markets like Central Coast. You have northern part of Northern Virginia, other than the Bay Area, so above the Bay Area, like vacation and second home markets. They're not doing that well. Generally, I would say across country right now, secondary vacation markets are not doing well because they did so well during the
Right.
pandemic.
Well, one of the stories is Canadians are trying to sell their houses in large numbers, that they don't want to come to the US for their second homes anymore. I don't know if there is a strong foundation to that story or not.
It's hard to tell because there's not good data on that. One
Mhm.
data source is NAR, and they do their annual survey, which just was released I think last week,
Yep.
that showed that international sales went up, but that was leading up to March of 2025. So it was like the year prior to March 2025. So I don't know what happened since, because really the rhetoric sort of picked up since then.
So, Selma, let's continue our tour. We'll leave the Bay Area and now go up to the northwestern part of the country. What's happening in the Seattle area?
Yeah, so Seattle, it's been a market with ups and downs, and it's been a little bit slower relative to maybe some, like coastal California definitely saw like more increases and more dynamics. Seattle, not as much dynamics, but I did see in migration data there it was a persistent outflow of folks leaving that area, and so it could be potentially that they're leaving Seattle itself for adjacent, more affordable, smaller towns. So, for example, Seattle home prices on a year-over-year basis are up only about 0.7%, but then Tacoma is up 2.8%. So there is a search for affordability, and you see that, outside those dynamics that we talked about that are specific to the Southeast and South. The other regions, you're seeing mixed over results depending on if an area is affordable or not, what's happening employment wise. And so I would say there that Seattle does have that like mixed picture.
So, when you talk about Tacoma being about 2.8, it does make me think that's the CPI number came in at 2.9 the other day. And so what we're really talking about even in Tacoma is real house prices are flat.
Right,
And
right.
remind me, I mean, we started with the national numbers. What's the year-over-year national house price
It's
increase?
1.8.
1.8. So in real terms, in purchasing power terms,
Yeah,
houses are worth less now than they were a year ago.
right, exactly.
Yeah, yeah, yeah. Okay. Let's move on to the Rockies, and in particular, Boise is you used the phrase poster child for what happened in the during the pandemic. Lots of people moved to Boise. They got very annoyed, in particular with Californians. Tell
Yeah.
us what's been going on since then.
Yeah, so a lot of it was the top appreciating market in the first couple of years of the pandemic because of these migration patterns, and then you had 2022 where both migration to that area slowed, and we saw a rise in mortgage rates, which made it very, very unaffordable for local residents to afford to buy homes in that market, and so that was one of the first markets that saw a drop in home prices. Now we're seeing a little bit of a rebound. It's not nowhere near it was, pre 2022, but we're seeing some rebound both in home sales and in home prices as well. So, I think it's just a market that's readjusting to what locals can afford, not necessarily Californians, but locals.
Yeah, yeah, yeah. So that immigration has it remained pretty slow after that remarkable ramp up in the first
Yeah,
years
yeah.
of the decade. Yeah, yeah, yeah. So that makes a lot of sense. And now what about Denver?
Yeah, Denver, what's interesting to me about Denver is it's t market with largest increases in inventory overall in the last year. So when you look at inventory for Denver, both for existing and it's also one of the top new construction markets, not maybe not Denver itself, but surrounding areas. So it has a lot of inventory. So because of that, did see slowing of home price appreciation in Denver. It's essentially flat, not in real, so it's down 0.1%. Real terms, 2% down now. But it's not to me as concerning of a market. Now, it is a market though, when you think about wildfire risk and sort of pricing of insurance. Oh, the other thing about that market, is it saw one of the largest increases in property taxes. It has such structure of property taxes that tax increases are based off of whatever home price increases were. So similar to Texas, what we were talking about. And so when we looked at the escrow needed for median homeowner, that escrow went up 30% in just 1 year period from 2023 to 2024. So it became really expensive for even existing homeowners, right, to maintain that home ownership. So so I think that's sort of feeding into issues in that market, but it's still a very large immigration market. It's still, a big job market. So I'm not as concerned about that market, maybe as, some of the other ones.
One thing that always puzzles me a little bit is, let's say, I'm going to just make up an example. Let's say property values double.
Hmm.
That doesn't mean governments need to spend twice as much money,
Right.
right? It is schools haven't doubled, fire departments haven't doubled, parks haven't doubled, police departments haven't doubled, and so on.
Yeah.
And so I always wonder why communities, when property values go up a lot, don't lower their property tax rates um, so that you don't have this sort of affordability shock, which
Hmm.
leads to a political resentment of the property tax, which I think in a lot of ways is a really good way to tax things locally. But
Hmm.
it's always this is what happened in California in the 70s. House prices went up a lot, so property tax went up with them, and we got Proposition 13 as a result of that. And it sounds like something very similar is going on in Denver, and we've already talked about Florida and
Yeah.
Texas in
Yeah.
that regard.
Yeah. But we did work with Denver tax assessment department in trying to find ways or trying to identify communities where people are you know more income sensitive to this and how they can help these folks and so I think at least in Denver or Colorado, it does seem like local governments are aware of what that potentially could mean down the road.
Okay, that's good to know. So let's move to the part of the world where I grew up, the Midwest, and it's known for being cold, but in the housing market right now, it's pretty hot, right?
Yeah, yeah, it is one of the strongest appreciating markets, that in Northeast, Midwest and Northeast. It's been the case for the last year or so. And people often, sort of wonder why, it's not a high migration market. It's not necessarily strong, most dynamic labor market, but it's affordable market. And that makes a huge difference. And the other thing too, that's really important right now in terms of what's happening to home prices regionally is it didn't appreciate a lot during the pandemic. So there is not that, reset or, case of overvaluation. It's just steady as she goes sort of thing. Most of the Midwest is like that, and so you see more steadier long-term, price growth and not as much volatility in the market as we see in some other markets.
Yeah, it's funny. If you look at rents over a long period of time, Chicago has the most stable rent of any large city in the United States. And
Interesting. Yeah.
yeah, and so it also makes sense that you don't get the volatility in house prices. But are there places in the Midwest where there is some in-migration?
I do think so. I think, Ohio, for example, some of those, I think Ohio was sort of like on a hot list last year. I'm trying to think what other places. Well, Michigan, I don't know about migration in, like a longer term migration, but it was pretty hot, like vacation market,
I
because
see.
so you did see a lot of appreciation there as a result. And I do think that to some extent, CHIPS Act and IRA and infrastructure spending did help some of those regions and maybe created job opportunities, and hence demand for housing.
So let's finish off with the Northeast, Boston, New York, Philadelphia, et cetera. What's going on over there?
Yeah, yeah. Same thing, some of the most strongest appreciating markets at the moment. Also, the same story in terms of not a lot of appreciation during the pandemic. Cumulatively, even though they're seeing now upper single digits, cumulatively not, they're still lower than the national average or those markets in Florida or Texas that we were talking about earlier. So still less than that 40% cumulative increase. So there's some catching up there. But also, I think, when you think about, so that's one component of that. The other one is, that the call back to the office, to work from office, I think that drove some of those folks that were maybe checking out other markets in the country back to that region. And so markets that surround New York, that are, more, you know, lower density, sort of more affordable. That's where you see, and Connecticut too. Though Connecticut is not definitely more affordable, but I think Connecticut, what's happening in Connecticut goes top. I think three markets are in Connecticut for, almost double home price appreciation, double digit. It's an income, I think, effect from New York. I mean, whenever equity markets are doing well and you get a bonus season in March, you see, in boost in demand and home prices for those higher end properties. So I think that's what's happening there.
So I'd like to finish off our conversation on a couple of topics that are more big picture. And the first is the impact of investors on the single family housing market. And I still see elected officials blaming investors for prices being unaffordable. And I know you and Cotality have done work on this. What have you been finding?
Yeah, so I mean, definitely the level of investor activity has gone up over, since 2017. I think that's sort of, but there's a tax benefit too. We're talking about the big beautiful bill now again, and what the tax benefits for investment in real estate is. There is still that tax benefit. So, I think that's really what has initially boosted investor activity. And so, according to our data, about anywhere between 20 and 30% of single family homes go to investors. One thing to keep in mind, there could be exchange between investors, so sale from an investor to an investor. It's not necessarily that it's all going out of the traditional pot of group to a this.
That's a really important point. And I should know this, but I don't, about what share of single family houses are for rent at any point in time? It's a good number, right?
That's a great question, Richard. I have no idea.
Okay. All right. We will figure this out, but
Yeah.
just sort of we know there are about 40 million rental households in the US, and it's a little more than that, but I'm rounding. And about half 55% live in 1 to 4. So let's say 40% live in one single family houses. So 40% of 40 million is like 16 million.
Yeah. Yeah.
And out of what, 85, 90 million single family houses in the US, something like that. So you're looking at just in steady state, 16, 17%, a little more than that, of the
Yeah.
housing stock is in the hands of investors. And um, and if I made a mistake just now, I'll clean it up later.
Yeah. Yeah.
But uh, And most of these investors, of course, are not big corporations, right?
Mm,
They're individuals who
yeah.
buy a house and rent it out. And so 30% still sounds like kind of a big number relative to that, but a good chunk of that 30 is in fact investors selling to other investors.
Yeah, yeah. And also, like you said, the majority are small investors. So 50% of total investor group is 3 to 10, those that own 3 to 10 homes. So we consider those small investors. It's only about like lower single digits, I want to say about 7% that is mega investors or over 1,000 those that own over 1,000 properties. And that actually has slowed, it's reversed in favor of more small mom and pop investors. So yeah, I
So I
think
just want to underline that. So mom and pop investors are now becoming a bigger share again of
yes,
the single family home investment community.
yes, that's correct. Yeah. Yeah, and the other thing that varies quite a bit is the types of investors are different in different regions or in
Yeah.
different metros, right? So this institutional investors that everybody thinks about, it's mostly dominating markets like, Dallas, Atlanta, Charlotte, the southeastern markets. And I think where they go where jobs and in migration goes, whereas small investors, they dominate in markets like SoCal because they are relying on a lack of homes, shortage of homes. So they know they're going to have a pretty steady um, um, demand, I guess, given how much shortage we have of homes in California. So that's where you see the small investors mostly.
So let's finish by talking about climate risk because you've developed a measure of climate risk, yes, for each house or each neighborhood. So tell us about what it is exactly that you're up to, and then I'll have a follow-up question.
Okay, so I wish I could say that I did it, but it was an amazing team at Cotality and a team of a lot of people that did this. But I'm I utilize the data. I'm a data consumer, and so it's called hazard risk score, and it assesses the potential of impact of natural disasters on a property. And so we've developed this for all properties in US, including single family homes and commercial real estate. So we have a score for each property in the US. And so the way it works is that and so then we also developed the score for different types of natural disasters. So there is a wildfire risk score, there is a flood, earthquake, wind and storm, and so each, and then there is also a composite score which sort of takes into account all of this and creates some sort of composite. And what's interesting about these scores is they don't take into consideration just you know weather patterns or climate in an area, but also the type of property, structural characteristics. If the property is, what's the elevation of the property? What's the proximity to, say, areas that are very prone to wildfire risk? You have those really dry areas of California that, if your proximity to that, your wildfire score goes up. But then it gets adjusted for materials that are used in your home, so there is that. So it takes into consideration not just the climate part, but structural part as well.
And so you've been able to correlate that with home values in different markets, or are you working on that? I mean, tell us how you're implementing this as a tool.
Yeah, so there's a lot of applications. The way our clients use it is for underwriting risk. It's for risk management. It's for disaster recovery planning. What we do is we do look at how those risk scores impact but the probability of, say, going into a default in
Ah.
mortgage delinquency, and then what is the impact on rent and prices post natural disaster. And so, there's so many questions to ask with this data. I think we have yet to scratch the surface.
Well, I guess so. Let me suggest a couple. One, it would be interesting to know whether, first of all, prices are sensitive to this in general. So you would think that something subject to flood risk, say, might, all else being equal, uh, sell for a little less money than something that's not. But also, the relative impacts of these different risks on marketplace perspective. So are people more afraid of fire? Are they more afraid of floods? Are they more afraid of hurricanes? Kind of go with floods. Are they more afraid of earthquakes, etc.? And
Yeah.
so, yeah, I think there's a whole lot of mining to do with this stuff to see.
Yeah, yeah, absolutely. So in terms of pricing, we've already seen markets, and we talked about that when talking about the Gulf Coast region of the
Yeah.
US. You were already seeing areas that have high exposure to floods. But mind you, the awareness around floods and stormwater surge is, among your regular folks is not that deep, so sometimes people are not aware what could happen other than they see persistent natural disasters hitting an area. And so Louisiana is a great example of that. It's one of the slowest appreciating markets in the country. It has some of the highest delinquency rates, so it's just a market that's really in the sort of Iowa storm, not Iowa.
Yeah. Well, it is, right? Yeah, literally, not just figuratively.
Yeah, yeah, and so it gets impacted a lot. So we do already have a lot to say based on that example. But in terms of mobility, what's interesting too is a lot of times areas that do have higher exposure, sometimes are more affordable. So when you think about California and you think about urban rural yeah, is it urban rural interface?
Yeah.
That's where you can build, that's where homes get built that are more affordable. And so people move there, like, Altadena, and so, what happened in Altadena is a good example of that. So unfortunately, the other thing is, Florida, is a high magnet market. It attracts a lot of people because people sometimes either don't take climate seriously, or they're thinking, okay, in my lifetime I'll be fine. Or it's really when you start hitting their wallet with insurance costs that now you're seeing people start to pay attention. And so migration patterns up until this point were not necessarily correlated with understanding of risk, but I see that moving in a different direction going forward.
And so I'm curious, so do insurance companies talk to you guys about what you're up to?
Yeah, yeah, no, we have a whole insurance group within CoreLogic. CoreLogic has actually expanded our insurance group. So we do work with a lot of insurance companies and their user scores. And in states, so insurance pricing is also a legislative thing at the state level. So
Yes.
like in California, you can't, but in states that it's more easy to adjust insurance costs based on risk scoring is being used. So yeah, so absolutely.
Yeah. So another study I would like to see done, and I don't know of one. So I'd love to see the impact of insurance on house prices. So
Hmm.
if you get a big increase in insurance in an area, do you see house prices there fall relative to the rest,
Yeah.
nearby areas?
Yeah.
And along those lines, where we started is HOA fees. If you see a big change in HOA fees in the
Yeah.
short run, you get a decline in house values relative to other areas, which, if you have a 40-year-old building, you have a 40-year-old building, it needs to be redone, regardless of what the HOA fees are. So whether the HOA fees are realistic now or not shouldn't
Hmm.
matter.
Yeah.
I suppose reserves should matter. If you have a lot of reserves, then you should have a more valuable building.
Yeah.
But it seems there are all these price signals out there, and we need to start sorting out how they're influencing these very micro level housing market dynamics.
Yeah, yeah. Well, condo market in Florida is already, and that is, I don't know if I mentioned this already, but in our home price index, we separate detached and attached housing, and attached housing is actually down in no on a no in nominal terms on a year-over-year basis is down almost 1% versus detached, and a lot of that comes from the weakness in Florida condo market because of the HOA reserves.
Mhm.
And also, well, surge in inventory as a result. It's really supply and demand, always comes down to supply and demand. And so the other thing I did want to, you mentioned something about insurance, and I lost it.
So, like, if you have a neighbor, let's say you have a zip code and insurance goes up there more rapidly than the surrounding zip codes, do you see that? Do you see a discernible impact on house prices in that neighborhood?
Right, right.
Zip code's
Yes.
probably too big, census tract.
Yeah, yeah. So, insurance cost is like famously hard to, insurance premiums are famously hard to come by. The way we go about estimating insurance costs is through our escrow data. But what you don't know necessarily is, what does it cover? Is it just,
Yep.
what is it? Is it addendum A or whatever it's called? So it's a very messy thing that I think nobody has yet really gotten a full grasp on, you know. And then when you look at insurance costs being recorded, like quotes, there are companies now that will tell you at the zip code level how much insurance costs are, um, how much insurance costs are. But then you compare different companies and they have vastly different averages. And so,
Sure.
like, what do I take? It depends on, I guess, who is inputting the data, right? Who is inputting the quote. So it's been a really hard thing to really wrap our heads around. But the last thing I do remember now, what I wanted to mention is that we are seeing risk starting to being priced into mortgage rates. So we do see markets that have been exposed or have had natural disasters. The cost of your APR mortgage rate being higher in those markets relative to those that have lower risk scores. So it's going to become more expensive, or it is more
No.
expensive now borrow in those markets.
Now, given that the vast preponderance of mortgages are guaranteed by Fannie, Freddie, Ginnie, I'm trying to think so are these, well, Ginnie couldn't do it, but are Fannie and Freddie changing their pricing based on climate risk?
Yeah, I think it's a big hot potato right now. I think there was some attempt at that, and then that got squashed. So I don't.
Yeah, yeah, yeah. I'm just trying to think where these differences in price come from. I mean, if it's on the private side or the
Yeah, yeah,
non-GSE side, you could certainly see where that would come from.
yeah, yeah.
But
Yeah, so another example of that would be that um, loans that are originated in these high risk markets are more likely to be sold off and not hold in portfolios,
yep.
so that's another version of that.
So, well, Selma Hepp, thank you for spending some time with us today. It's always great to hear what you're finding out about housing markets around the country and about the research that Cotality is doing. The stuff on climate risk is really interesting
Yeah.
to contemplate, and I think your work has really been among the most useful in terms of the single family investor market of anyone out there. So again, thanks for joining us today.
Thank you. Thank you so much for having me, Richard.